There will be major tax legislation, and if Trump and if one party wins all three branches of government. So if Trump wins all three branches of government, the TCGA provisions could be reenacted, and so that would require legislation between the presidential inauguration at the end of January, and he's got 11 months then to pass the legislation, which actually did happen in 2017. Remember, when the TCGA was passed, 5 out of the last 6 presidents had a unified government. Obviously, Biden did. Obviously, Obama did when he passed Obamacare. Even George W. Bush did. So the key is if the winning presidential candidate also takes both houses, some of these enactments there will be major tax legislation, and then people like us are going to be really, really busy.
We have a lot of our clients that are looking to establish pools of capital outside the United States in other established jurisdictions. Most of my clients have a significant Bitcoin position. Some of them are also in some of the thinner branches of Web3 and crypto. We've got a lot of clients that are traditional wealth clients as well. But a lot of what we talk about with our clients is just you diversify across your portfolio, but it's not just an asset diversification. It is a structural diversification, and it's a jurisdictional diversification as well. And within those jurisdictions, there should be a custodial diversification. And so, yes, home bias as far as near-term opportunities, regardless of the election outcomes, I think because of the geopolitical risk that we're seeing more broadly. But making sure that you're not just opportunistically taking advantage of other jurisdictions, but thinking about those as additional security havens for wealth.
I can't believe that this is something that we're even considering, is taxation on unrealized gains. And of course, that's only going to apply to the billionaires. So don't worry, you centimillionaires and people.
100 millionaires. It's a billionaire's tax that applies to people at 100 million. Aspiring billionaires.
But if you will remember, which probably most of you don't, because it was 1913 when the U.S. income tax system was set up, that only applied to the upper echelon of taxpayers also. There were still, up to a few years ago, taxes from the 1800s that only applied to the upper echelon dealing with telephones because they were the only ones that had telephones. So the nonsensical idea of going against our basic economic and basic ideas of what is fair, I think could really throw this whole country and this economy in for a tailspin on the taxation of unrealized gains.
For all of you who made it here to the end of the day, thank you. So obviously, apparently a lot of people checked out. But we're glad to have you, and we're going to try and make this as interesting as possible. I know tax and estate planning get you all fired up. So, I didn't parachute in or, play rock and roll music to enter, but we do have a rock star panel here. I know, and I have talked to a number of these guys over the years in different settings. This is a brain trust here, and I've sat in the room with a number of estate planning and tax specialists over the years, and these guys are incredible, and they add a lot of value, right? We talked all day about how to make money. Now we're going to talk about how to save it, preserve it, and pass it on to your family and your causes and things that are valuable to you. So glad you're here, and we're going to try and add as much value as possible. I want to let you guys each introduce yourselves, and then we'll jump into some questions.
Okay, thanks. My name is Matt McClintock. I'm founder of a multifamily office called Bespoke Group. I'm a recovering estate planning attorney. Did that for 25 years and kind of accidentally founded a family office around a handful of our 9-figure Bitcoin clients, and that's kind of become the story of us. And when Paul said he was coming as Tom Cruise today, I told my wife I've got to come as the well-dressed homeless guy. So that's why we're sitting next to each other on the stage.
You're pulling it off.
Recovering attorney, I like that. Dan Rahill, you heard me speak this morning. So I am an attorney and CPA and certified financial planner.
Eric Kalnins, I am a partner at the law firm of IceMiller. I practice primarily in the areas of business structuring, tax, estate planning, and we have a big part of our planning involves the family office market. I moved down here a few years ago, live in Naples with my wife and 3 kids, and I'm setting up our firm's first Florida office in Naples.
Great. So where I want to start with you guys is that, we've obviously this election that's coming up has a variety of outcomes that we could see. And let's kind of set the stage for this whole panel by asking you what you see on the horizon, regardless of who wins the election, and in the circumstance of we get specific outcomes related to each individual party. What are the challenges that might be on the horizon, and what are the different outcomes that you see? We'll start. We'll just go down the line. We'll start with Matt here.
What I see, at least from a lot of my clients, what I think they're right. There was a comment earlier about kind of a home bias from an investment perspective, which I echo that as well. But kind of the other side of that is a concern of having all of the eggs in one basket. And so we have a lot of our clients that are looking to establish pools of capital outside the United States in other established jurisdictions. Most of my clients have a significant Bitcoin position. Some of them are also in some of the thinner branches of Web3 and crypto. We've got a lot of clients that are traditional wealth clients as well. But a lot of what we talk about with our clients is just you diversify across your portfolio, but it's not just an asset diversification. It is a structural diversification, and it's a jurisdictional diversification as well. And within those jurisdictions, there should be a custodial diversification. And so, yes, home bias as far as near-term opportunities, regardless of the election outcomes, I think because of the geopolitical risk that we're seeing more broadly. But making sure that you're not just opportunistically taking advantage of other jurisdictions, but thinking about those as additional security havens for wealth.
Dan?
Let me approach that question from a tax planning point of view as opposed to investment. Let me just talk about Harris's proposals for a second, and this is from a PowerPoint that I've been giving lately. While she's not going to touch people, she says, with income below $400,000, which was the Biden approach, she is going to raise rates for everybody above that, including raising the corporate income tax rate from 21 to 28%, raising the capital gains rates from 20 to 28%, and making the net investment income tax, which is a bolt-on, we call it the Obamacare tax, a 3.8% tax on investment income, to apply to all income and raise it to 5%. So that would raise capital gains rates for family offices on the sale of appreciated property from 23.8% to 33%. So I know some investment advisors right now that are capturing capital gains in advance of the election. Personally, I think it's a little early for that, but I know some that are doing it. She's talked about, and this would apply to family office investments, increasing the startup expenditure deduction, 179, from $5,000 to $50,000. So she's trying to spur more startup work. So maybe that applies in the Bitcoin arena. I don't know. And an annual tax of 25% on total income for people with wealth greater than 100 million. So if you do have clients, or you are of income more than $100 million, you could pay an annual tax on unrealized capital gains. And no, you don't get a refund. If it depreciates, you only pay. If it appreciates, and you get a carry forward a benefit for the amount of tax you paid. Now she's talking about stock buybacks. Let's talk about the buybacks of public companies, especially tech companies. Raising the buyback tax from 1% currently that Biden enacted to 4%. And then there's a lot of giveaways in there, raising for expanded child care credit to $6,000 for children under 1 and $5,000 otherwise. So there is a lot of giveaways in her proposal to kind of win votes, and she's going to pay for it on the backs of capital gains and corporate tax increases. The Trump proposals are obviously brief. He doesn't get into a lot of detail, but he's talked about lowering the capital gains rate, or the corporate tax rate, so those family offices that have C corps, from 21 to 15%, but only for certain qualified businesses that make their products within the United States and 20% corporate rate for all others. So if you make your products, and I don't know, devil's in the detail is how much is within the United States, because obviously we're in a global world, right? But it would be 15% corporate tax for U.S. manufactured and 20% otherwise, and some other things. I mean, Vice President Harris also jumped on the bandwagon on not taxing tips. I mean, that's a political play that they're trying to get votes, and also exempting Social Security benefits from total taxation. That's in the Trump proposal. So there are other proposals. He would extend there are over 30 provisions of the Tax Cuts and Jobs Act from 2017 that are going to expire at the end of 2025. As you know, put my estate planning hat on right now. That is a major focus of mine and everybody else on this panel is an attorney, and we are preparing for that. There will be major tax legislation, and if Trump if one party wins all three branches of government. So if Trump wins all three branches of government, the TCGA provisions could be reenacted, and so that would require legislation between the presidential inauguration at the end of January, and he's got 11 months then to pass the legislation, which actually did happen in 2017, remember, when the TCJA was passed. If Kamala Harris wins and the Democrats win all three branches, there will also be major tax legislation along the lines that I just talked about. If we have a split government, there's a good chance there will be some bipartisan agreement. For example, Trump has come out, and the Republicans, they want the SALT cap to expire in state and local deduction for itemized deductions. And obviously the Democrats want that too. Changes in the opportunity zone that I was talking about this morning, legislation extension of benefits there. So there are a number of things that both parties do agree on. So there probably will be some bipartisan agreement in legislation sometime in 2025 if it's a split government. But not a lot, as you can imagine, similar to the last couple of years. The legislation would, just like I think 5 out of the last 6 presidents had a unified government. Obviously Biden did, obviously Obama did when he passed Obamacare. Even George W. Bush did. So the key is if the winning presidential candidate also takes both houses, some of these enactments, there will be major tax legislation, and then people like us are going to be really, really busy. And I think we can talk about that further in this panel.
Thanks for basically taking every tax point, Dan. Appreciate that. But most of my clients, when it comes to this question, they're not asking, oh, what do you think is going to happen if Trump is elected? It's always, what do you think is going to happen if Harris is elected and the Democrats take both houses? And we know one thing, in 2026, a lot of things are going to automatically occur with regards to the federal estate tax exemption going, what will be at 13.9 million, down to about 7 million. And that means there's going to be a lot of opportunity over the next year and a few months for us to get assets out of people's estate, put them in an asset-protected environment, income tax planning, all of those types of things. The other big thing that people are talking about, which I can't believe that this is something that we're even considering, is taxation on unrealized gains. And of course, that's only going to apply to the billionaires, so don't worry, you centimillionaires and people.
100 millionaires. It's a billionaire's tax that applies to people at 100 million. Aspiring billionaires.
But if you will remember, which probably most of you don't, because it was 1913 when the U.S. income tax system was set up, that only applied to the upper echelon of taxpayers also. There were still, up to a few years ago, taxes from the 1800s that only applied to the upper echelon dealing with telephones because they were the only ones that had telephones. So the nonsensical idea of going against our basic economic and basic ideas of what is fair, I think could really throw this whole country and this economy in for a tailspin on the taxation of unrealized gains. Of course, a lot of you also probably heard about the $80 billion being allotted to our friends at the IRS because they need more money, as well as 78,000 IRS agents. Now, a lot of that isn't necessarily true with regards to 78,000 IRS agents. Over the last couple of years, they've picked up about 20,000, but of course 12,000 are retiring. So you always have to think about what the end number is there. But that's going to be a huge deal for our ultra high net worth and just as well as high net worth clients over the next number of years, because a lot of that money is going to be used to go after AI and the technology. I do tax litigation. I have a couple of cases going now. I've dealt with audits, appeals, tax court, federal district court, and the talent level at the IRS is pretty low. The other problem is they don't have that many people. Could they use a few more thousand? Yeah, probably 5,000 net to make things go, because when I have clients calling me saying, Eric, what's going on with this tax audit or this tax litigation matter, they just don't get back to you. During COVID, they just didn't work. I had an audit going in San Francisco. She says, Eric, everything's closed down. We can only come in once a week, get a box, a banker's box, take it back with us, because they will not let us use VPN or anything like that. Well, guess what? They're still not back in the office in DC. So they're so far behind that they do need some of these things. But a lot of that money, 60% of the $80 billion, is going to be going towards automated technology and those types of things. And guess who they're defining as far as who they're going after? They're going after the corporations, complex partnerships, and high net worth individuals. Those are all our clients. That's us. So you're going to see a huge number, or increase, I should say, in audits, because even though they may not have the talent, because, hell, I have a hard time finding other attorneys, CPAs, accountants, because the talent pool is just, there aren't that as many people as there used to be in that field. So how is the IRS going to get that talent when they have to get tens of thousands of attorneys, data analysts, data scientists, accountants, CPAs that compete with the private sector? So back to your basic question, I think that's where we're going with this. I think we're going to see not just, have your proper planning and all that kind of stuff, but you're going to see an IRS that's going to be very aggressive, and they're going to be able to use the technology and AI to pinpoint exactly where do they want to go and get their money. Because when it comes to the IRS, one thing they are good at over the past few years is for every dollar they spend, they get another $3 to $4 in revenue. So it's really the only part of the government that works when it comes to really making money.
Well, there are a couple of things I wanted to kind of touch on that was right with you on that. One I wanted to underscore, and one I thought I wanted to kind of amend as well. My understanding is that a lot of the additional allocation of taxpayer dollars to fund the IRS is also going towards digital asset transactions. And so there's this widespread and probably somewhat accurate notion within the service that digital asset transactions have been underreported, gains have been underreported. And my understanding is in conjunction with U.S. Marshals and others, they're really going after digital asset transactions as well as the other ones that you listed.
Well, starting this year, 1099-Bs apply to crypto
for sure.
and digital. So
yeah, but the other thing I want to land on too, which I just really want to underscore, both of you guys touched on it, is we know that regardless of who is in the White House, the 2017 Tax Act, as it relates to the gift and estate and the generational transfer tax exemptions, that will expire on its own. President has to do nothing. Congress has to do nothing, which is what they're really good at doing. They don't have to do anything. And then the 2017 Tax Act will sunset 12/31/2025. So then the $13.99 million estate tax exemption, so it's $10 million plus adjustment for inflation, will sunset and come back to $5 million plus adjustment for inflation. So for even fairly affluent, let alone the ultra affluent families that we either are or that we serve, they must make sure that they don't leave available estate tax exemption on the table. I think that as a wealth manager, as a wealth strategist, we need to be thinking about the tax code and especially the gift and estate tax exemption as an asset to plan for as strategically as we would plan for any other asset.
That's great. That's actually a good lead into my next question, and I wanted to direct it to Dan to start, and then I'd love to have you guys fill in. So this is a really volatile environment, obviously, with lots of optionality. How are you working with clients right now to review and restructure them from a trust and estate planning perspective as well as a tax perspective?
I'm doing a lot of document reviews right now. And, you know, a typical rule of thumb, I don't know what you guys think, but you should review all your documents at least every 5 years, or if there is a life event, you know, someone gets born, someone gets divorced, et cetera. But everybody now, we're reviewing those documents, and what are we looking for? Well, obviously, the lifetime exception, right? The 13.99, it's a use it or lose it situation. 13.99 is next year's number, 2025. We're looking to utilize that. We're coming up strategies to utilize that. When I look in their documents, what I want to see also is, have they included certain provisions such as swap powers, you know, or and what that means, if you're not familiar, is, and these guys draft it all the time, if you put an asset in today and it appreciates greatly at the end of life, let's say in 20, 30 years, this has got huge appreciation. Well, when you put it in that irrevocable gift trust that you had carryover basis, what you want to do is bring it back into your estate, or the grantor wants to bring it back into the estate, replace it with cash or something that's not appreciated, die with the asset, family gets a step up in basis, okay? Assuming the Democrats don't change that. So, you know, we look for things like swap powers, and we look for trust protectors that keep the you know, the intent of the grantor in place. And finally, lately, I've actually run into 4 situations in the last 2 months where I'll be redoing someone's plan who's in their, let's say, 60s, late 60s, and at the end of the conversation, we'll go, do you or your spouse have a parent who's still alive? You'd be surprised at how many have parents who are still alive at age 92, 94, 95. And I said, oh boy, we are going to do something called an upstream basis trust. Oh, what's that? And this is a fairly new concept, but we make sure that grandma, usually it's grandma, grandpa's long dead, usually grandma's still alive, and I'm thinking of several, I've got several grandmas. We give her general power of appointment in the SLAT. Let's say we do a special lifetime access trust, and we use a unified credit that way. We give, and we put in a lot of appreciated property. Let's say it's real estate or Bitcoin. I suppose Bitcoin would qualify. And it's got a low basis. We give it. But when grandma dies, because if she's got something called the general power of appointment, the whole thing gets stepped up in basis. Boom. We just stepped up to $13-14 million. If she has not used her unified credit, we have to make sure, and I've got several clients checking right now, some are sure that their mother has not used the unified credit, and others are checking, you know, and I'm going to make sure that that clause is in there to give them the GPOA, the general power of appointment, so I get to step up in they get to step up in basis. I'll feel real good if they do, because you could step up, you know, $10 million or 40% is $4 million bucks, right? I mean, you got to own a lot of Bitcoin to make that in one move, you know. So we can make money as estate planners, and I always use the CPA side of my brain to quantify anything I do. Every strategy I do, I give them a number, and this is what we do, or I give them a spreadsheet, and this is how much it saved you, and it does get your client's attention. It gets them off their rear ends into the office, and I usually go to the first meeting with whoever their attorney is and explain in charts what I want to do in a flow chart, and they get it, and boom, we're done.
Yeah, one thing I like to do with clients, especially approaching 2026, is what I refer to as an advanced planning memorandum. So when people say, Eric, what should I do? What should I do? What should I do? These are complicated structures. There's a lot of complexity here. So especially if it's a newer client, it's nice to just take their assets, pull them all together. They give you all the information. You create a schematic. I'm a big believer in visual aspects of everything. It's definitely worth 1,000 words. Say, here's your current structure. And typically it has a trust somewhere over here. Nobody knows who owns this, whatever. And then we run a calculation of what we think, if they died today based upon their current structure, what would your tax bill be? And what's your asset protection profile if you get sued and somebody tries to take your assets during your life? And then we have this whole write-up of all the various planning things, from virtual family offices to single family offices to sales to slats, slants, all these types of things that are there, basically creating a cafeteria plan for them. so that they have this booklet where they can see their assets, see how things are titled, whether they're in the green, which means maybe pensions, offshore asset protection trusts, things of that nature. And then you put things in the yellow where it's somewhat protected, and then in the red where it's not protected, and say, if you retitle these things, restructure them, this is how it works. But that also gives us a plan to say, here's something solid, look at it with your family, now tell me what you want to do, as opposed to us talking on the phone about these very nebulous standards from a 32,000-foot view. So once we can do that, we can really narrow it down to certain things, and they can look at that, their investment advisor can look at it over the next year and say, oh yeah, we haven't done this yet, we should talk to Eric about that. So putting things down on paper is really important, creating a visual.
Yeah, I agree with all those statements. I've been at this long enough, probably like these guys too. It's like I've gone through other cycles in the tax code where sometimes people have overplanned. The tax code changes, and now they've put more of their assets beyond their reach than they really wanted to through a series of irrevocable trust structures that can become kind of difficult to operate within. So a lot of what we designed while we were in practice and now what we're helping manage through the family office environment is ways to build flexibility into these irrevocable trust structures. Dan highlighted a couple of them, but we do a lot of resitusing, which means simply relocating an irrevocable trust or maybe a company or a combination of things from one jurisdiction to a jurisdiction that has maybe more favorable or more creative statutes. We might want to use Nevada law or Tennessee law or Wyoming law or some offshore jurisdiction because it either has more favorable asset protection attributes, it has more favorable flexibility, it has the ability to get assets back into the hands of the creators of the wealth. Things like decanting, establishing a new trust that might have more favorable provisions, and then pouring assets from a trust that's kind of become functionally obsolete, pouring those assets into the new trust, again, probably in a more favorable jurisdiction. Dan mentioned the role of trust protectors. We've been massively bullish on trust protectors since before it was cool, and using trust protectors to effectively rewrite irrevocable trusts when circumstances have changed profoundly. Dan also mentioned the use, we've used the term upstream estate planning, where you're taking advantage of an available estate tax exemption amount of an older generation. Most of our clients are fairly young. They're 40s, 50s, but most of them are kind of 30s to 40s. Their parents are still living, their aunts and uncles are still living, their grandparents are still living, and these clients are the wealth builders. They didn't come from a tremendous amount of money. So again, back to this notion that an available estate tax exemption is an asset to leverage, we talk to our clients about looking across the family tree and very strategically tailoring these general powers of appointment, and that by its nature causes the value of the assets subject to that power to be includable in the person's estate. So I could create a trust, for example, for the benefit of my wife and my kids. And in that trust, I could give my dad, who has a very modest estate, I could give my dad a general power to appoint property in that trust for the benefit of, there's a way to kind of do it where it triggers estate tax inclusion, but it could also include his descendants, which might actually even be me, to make a general power of appointment. He can exercise his estate tax exemption to create a dynasty trust, maybe for my kids, other beneficiaries, whatever. It can be exercisable during his lifetime or at his death. And it can also be tailored by a formula so that if my dad wins the lottery, the value of his estate, of the power of appointment, is zero because it's driven by a formula as opposed to driven by a fixed dollar amount. The other thing I wanted to kind of touch on is just echo what Eric says about pictures saying 1,000 words. We did this when we were in practice with the law firm. We still do it through the family office, illustrating the client's present state, looking at the nature of their assets, looking at the cost basis of those assets, talking to them about what's their hold position, what of these are legacy assets, and then what planning is in place, providing a gap analysis that's visual and textual, and then creating a series of options that will help them execute that. I could not agree more with the importance of that.
Yeah, if clients call me up and I haven't spoken to them for a few months, I can pull up that. I always force it on one page as much as possible, and I'm like, okay, I remember their whole estate. That's really the only way to remember it. But going to what Matt was saying too, if you have a high or ultra high net worth client that doesn't have a trust protector located in it, you need to get a new trust or amend the trust or do what you have to do. I had a situation just a few years ago for a $100 million family. I don't know who drafted, well, I know who drafted this trust. It wasn't us. But it basically came down to decedent, skips over his son, only goes to his grandkids if his grandkids have kids. The kids aren't ever going to have kids. They're not able to have kids. So therefore, if nothing happens by 2050, everything goes back to son. So you have the real chance of getting hit with a double federal estate tax there. And if it weren't for the trust protector provision in there and non-judicial settlement agreements, we would have never been able, we had to go back and undo a lot of the planning where they used their gifting up many years before we knew them, just to get to a point where we're saying this is the best picture we can put there, cut a $20 million check to the government. The statute just ran a few months ago for 3 years. I'm very happy about that. But the client's happy, but the trust protector can fix a lot of things that weren't well thought out of years ago.
Yeah, and then something Dan said is right on too. It's the nature of planning has to be iterative. It can't be you just do your estate plan, you swallow hard, you check it off the list, and you've moved on. Your assets change, the jurisdiction's laws change, your priorities will change, everything will change, and you're talking about a series of complicated structures that are designed to be vehicles that transmit family wealth across many generations. You can't just check it off the list and say, yep, one and done, forget about it. All these strategies, various irrevocable trusts, the entities within the irrevocable trusts, they have to be managed very carefully, properly documented, refined as appropriate, because everything is going to change in this family's life over time. And if the documents that memorialize these strategies are stuck in time, then they're not going to deliver on the promises that the family expects from them in the future.
I often joke, and then I'll jump on dynasty trusts. Going long term, and the fact that I live here now, but and I also live in Illinois. But in Illinois, it's a 360-year limit on a dynasty trust. So going generationally, so one generation to the next, there's no estate tax until the ultimate end. And sometimes you see a 50-year timeline. Sometimes you see all the way up to 100. But in the state of Florida, and I always say, my friends have heard me say, "God bless Ron DeSantis," right? But on July 1, 2022, they changed the law in the state of Florida. There were two changes. One with slats and one with dynasty trust. Where now, instead of a 360-year trust in Florida, you can have a 1,000-year trust. So think about that. I'm thinking, who would need that? A 1,000-year trust. But the longevity, my point is, of these trusts and the ability to have a trust protector and the flexibility inside the trust that you both were just talking about is necessary, because the law is going to change, not only in the next 20 years, but the next 1,000 years, if that's what you've got going into perpetuity, practically. So flexibility is really key, and constantly, if you have a family office and you're the one charged with responsibility, keeping tabs at periodically reviewing the plan so that it's not, in the original, the intent of the original grantor that set up the trust, but that it also the laws that have changed over time don't mess with it.
So we're on question 2, and we have 9 minutes.
Well, that was three lawyers on.
Right, exactly. So you guys get the sense here, right? And from what you've heard today and what I know, these guys are all just scratching the surface. It's always valuable to have one-on-ones with these guys, and you apply it to your personal situation. So I'll just leave it at that. But let me jump to the family office question, because family offices are becoming more and more prevalent today. And wondering what you're seeing as far as like how these family offices are evolving, how the IRS is looking at them, and maybe we'll start with you, Eric. We'll go from there.
Yeah, they've evolved a lot. In my previous firm, we were sort of at the forefront of creating these structures in the early 2000s when nobody else was even thinking about them. basically setting up a management company as a C Corp, manages the holding companies. Then eventually, a thing called the Series LLC came out, which you could compartmentalize and still use the same name, and basically compartmentalize each risk asset you wanted in there. It could be conservative, it could just be straight up investments, public securities, offshore, whatever. And then each family's trust could basically invest in whatever area they wanted. The management company would get a performance allocation. You'd mark the assets mark to market every year, get the performance allocation. You'd basically take cash, or income, I should say, and push it up to the C Corp level where it could pay for accounting fees and attorney's fees, investment advisory fees. And through the years, it's become, like Paul was saying, much more prevalent. Now everybody thinks they're a family office. Everybody thinks they're providing family office services. I talk to law firms that says, oh yeah, we have a family office division. Oh really, what do you do? Do you, well, we do the trust, we do some concierge services, you know. Okay, do you do anything with performance allocations, business structure and all that? Oh no, we don't do any of that. So you're gonna hear a lot of people talking about how they provide family office services, trying to catch up if you haven't grown with that industry over the years. Like Dan mentioned earlier, 2017, a lot of things changed. The 212 deductions, you used to be able to pay for some of your attorney's fees above a 2% floor. Basically, it became even more imperative to turn this family office into a business. And it always should have been a business. It can't be running your own money, because case law shows that the IRS is not going to respect that structure. You have to follow the SEC family office exception rules, of course. But getting into 2017, we basically turned those expenses into 162 business deductions, because you're running a business. The management company is supposed to be going for a profit. And as long as you stay along those parameters, it's great. Now you had the lender decision around 2017, which really gave us a good idea as to what to follow, what not to do when it comes to making sure you're not running your own money, number one, but also expanding it and creating entrepreneurial risk, having a lot of the different family members involved, the more the merrier. And it may be just some bad assets too. It doesn't have to be all excellent assets, to mix everything in there. And then we have a Powell decision that came up later, so people are still looking at that. I think that's bad case law, but people still have to address it. But now it's become much more prevalent for people to want this structure, and what we're seeing with our family offices is they hunt out other family offices that made their money in the same industry, and they say, hey, let's go in on this deal together. So what you're seeing is this family office basically creating their own underground economy, I call it, that none of us can get into unless you're part of a family office, and basically leaving the rest of us dealing with investments at public securities and all that kind of 401ks and everything, while they have this underground economy where they can just kill it and get the tax deductions they need. It could be virtual, where you get people out there, attorneys and everything, that aren't necessarily W-2 employees, or single family offices, which are usually 250 million and above, where you have brick and mortar and all those types of things. But you're definitely finding now, more so than 15, 20 years ago when I started doing this, a much more consistent and well-respected theme in the family office market.
Family offices, some people call them the new private equity, in that, and I've seen an evolution of family office since I worked, gosh, you know, and I did do the benchmarking. I was in public accounting and had our, you know, well up a 9-figure, close to 10-figure family office, and I got everything dumped on me as a young manager, tax manager at KPMG, everything from, you know, the 50K1s to the helping to write the family foundation documents and charitable remainder unit trust documents and gifting $30–40 million away to this charity or that charity. We fast forward to today, and I see family offices, especially the 250 and up, acting like private equity, which is great. It's great to watch, because then they collaborate. It's a club, and they go in on to diversify their investments. They go in together, and probably several of you in this room do. It's great to watch and great to get involved in that. To also, to, you know, they'll want to say, hey, do you know so and so? I'd like to meet them. We're interested, and invite them into, let's say, a real estate investment. The one other thing I want to mention too that I'd like to see, well, I always suggest, and I'm doing a few right now, but is minority discounts. When setting up these family LLCs or LLPs, whether a partnership or as a LLC, as a corporation, or as a trust, whether you're a general partner in a partnership or whether you've got voting and non-voting stock in a corporation, taking that, again, the 30 to 35% minority discount on gifting to the next generation, I think that's a really valuable tool to be able to, and it works. I mean, it will stand scrutiny if you're audited. You may settle on 28% when you took 31. Great, you got it. So that works, and I'd like to see more of that. That's, again, kind of my background, being the accountant in me, loves to discount numbers, and I'd like to see more of that happening in the marketplace.
Yeah, and for me, we kind of became a family office on accident. We were a family office before we even really knew what the
No way.
what the term
That never
what
happens.
the term meant. I know. Yeah, come to find out, that's right. But we were basically a multifamily office, or we started really as a virtual family office for our first Bitcoin Sent to Millionaire before we even really knew what a family office meant. Because again, we were practicing law. We have a law firm. Had a law firm. We sunsetted it in July, but we were doing a tremendous amount of estate planning work for this Bitcoin Sent to Millionaire, and we met him in 2017. Back then, nobody was doing any serious legal planning, certainly not trust and estates planning around Bitcoin. And so I didn't know anything about Bitcoin, but I was curious enough to figure out what it is, how it works, and I thought, the answer cannot be that you've got this family with 9 figures worth of wealth and nobody's going to do their planning for them. So we had to figure that out. And then along the way, the client said, hey, well, will you help us with our banking relationships, because we're having a really hard time with that? And will you help us with the real estate contracts? And this gets back to something Sam said this morning, this idea of it's not my job. That can't be part of the lexicon if you want to provide great services to people. And we always saw these as, well, this is somebody who has a tremendous amount of wealth. They're asking for services that we can reasonably provide. Let's just find a way to say yes and just make it happen for them. And along the way, we started doing things in the Bitcoin space and kind of the broader, thinner branches of crypto for this client that were really starting to cross a line into regulated activities that if we were dealing with traditional assets, we would have violated the law with the SEC. But because at the time nothing was regulated in crypto, we just kind of kept doing it, like facilitating multi-sig and making relationships with custodians and stuff like that. But then as the law started to kind of shift in 2021, 2022, we formed Bespoke Group as a dedicated MFO, multifamily office with an RIA inside of it, got registered with the SEC. And then more of our Bitcoin clients said, yeah, I want to do that too. Yeah, I want to do that too. Yeah, I want to do that too. And before long, we have like almost $1 billion worth of Bitcoin and other digital assets that we're supporting for our clients in a very active way, not just with the design of the strategies with the trusts and other entities in different jurisdictions, but in the custodial relationships and the over-the-counter trading facilitation and you name it. So we just kind of became the company that just says yes to these clients, and that's kind of how we define the multifamily office for our handful of folks.
Now, if I can just add really quick, Paul, one of the issues I'm seeing more and more is a concern, especially amongst family offices, 1,000 years, it probably won't last 1,000 years. Sometimes doesn't get past the second or third generation. But in any event, successor trustees. A lot of people don't want to use a Northern Trust or a Bessemer, nothing against them, because they don't want to use the big box type of thing. And then I say, well, who do you want to use? Well, I'll use this person, this person. Okay, what happens in 30 years? I don't know. You're not even going to know who's around in 30 years after you pass. So private trust companies are coming up much more as a plausible thing so that you keep the family involved. They can be on the board as long as they're not a part of the distribution committee for their own funds and everything. It can make money. It can be a family bank. Florida has a private trust company statute that just came out less than a decade ago. It's created by one of the largest families in Florida, the Walmart family, the Walton family. It's actually here in Naples, Riverbend Holdings. And they not only help create the legislation, but they put provisions in there where if there's ever a dispute amongst the family members, it's closed in court. Who else has that in court where there's a dispute and you can just shut it down and nobody knows what's going on? So I think that's, you know, Northern Trust started off as a private trust company. Bessemer started off as a private trust company. So I think we're going to see more of a realm towards, you know, people have to think about who's going to be the successor in 20, 50, 70, 150 years.
I'm so glad you touched on that, because the identity of who the fiduciary will be that will be the trustee of all of these irrevocable trusts, that is the big issue. And so the other thing I want to touch on, in addition to the private trust company, is it doesn't really matter where you live. You can opportunistically select the jurisdictions to govern the management of your wealth. I happen to live in Colorado. Colorado trust law kind of sucks. I mean, we've got a 1,000-year rule against perpetuities, but it's not otherwise a very good trust jurisdiction. My irrevocable trust started in Wyoming because I just opportunistically selected Wyoming. I've since recited that to the Cook Islands and had through a trust protector action. I have a Wyoming series limited liability company. I've never owned property in Wyoming. I don't want to own property in Wyoming, but Wyoming has probably the best domestic LLC statute in the country. At least those of us west of the Mississippi would say that. I don't know.
And quiet trusts.
And quiet trusts. So you can be very opportunistic about the law that applies to the management of wealth.
So thank you all very much for an immense amount of information for us to digest. We're 3 minutes over time, but I wanted to give the audience an opportunity to ask questions. So if anybody wants to raise their hand, we'll make sure to get you a mic and let you ask a question directly to the panel. Crickets?
Crickets.
Okay. Oh, here we go. We have a question.
Out of fear, just standing between us and happy hour, I'll ask one. If you guys are too much knowledge to not ask one and don't want crickets. Thoughts on just like no watch deal with crypto and kind of where the government stands? I know we touched on the IRS, AI and stuff. Just freely, just kind of where you think about it and the advantages of that, things like grats and how that Bitcoin for G2, G3, you know, what you think there.
Yeah, I'll kind of touch on both of those, probably in reverse order. We've done a ton of grats for clients on this, with Bitcoin in particular. And we've learned along the way, kind of as we've understood more about kind of Bitcoin's natural rhythm, you know, kind of this 4 to 5-ish year rhythm that Bitcoin has. We've recommended now that if it works for the client's strategy, we would not do a grat for less than 5 years. Because we want the grat. We don't want the grat to collapse mid-cycle, and so really quick, like a 30-second primer on grats. It's a trust where you give away the future interest in property, but you retain a present interest in the property. And if to the extent the value of the assets inside that trust outruns this hypothetical rate of return from the IRS, it becomes a gift tax-free gift to future generations. It's a beautiful strategy when you have no other estate tax exemption left, and really ought to be part of the playbook of any affluent family. And another beautiful thing about grats is you can just rinse and repeat, rinse and repeat, rinse and repeat. If they fail, kind of no harm, no foul, you just do it again. But ideally, you put an asset into a grat when interest rates are fairly low, and to the extent the assets inside that grantor retained annuity trust outperform this hypothetical rate of return, that delta is what escapes gift tax. Bitcoin is a beautiful asset for that if you catch it at the right part of the cycle. Part of what we learned through our Bitcoin journey is we did a couple of 3, 4, 5 year grats, kind of laddered running concurrently, funded them with Bitcoin, and then Bitcoin market started circling back, and the grats ended up paying out all of the Bitcoin back to the client. Okay, again, no harm, no foul. She got all of her Bitcoin back, but the strategy didn't really have its effect of shifting wealth into the next generation. But what we've been recommending now more for clients is, if the life expectancy is suitable for it, Don't do a Bitcoin grat for less than 5 years, and then maybe you're going to ladder multiple grats concurrently, like a 5-year, 7-year, 9-year, all running at the same time. So you're kind of leveraging against the natural market cycle. And to piggyback Dan's idea, a lot of times what we'll see and what we'll recommend for clients is pair the grat with this upstream general power of appointment in the remainder, which means I can create this trust for the benefit of my descendants and my dad. And in this pooled trust that results after the grantor term, my dad has a power of appointment over that part of the trust. So he could then appoint that property using his estate tax exemption, and it can become generation skipping transfer tax exempt because he is the transferor from a generation skipping transfer tax perspective. Getting into some pretty esoteric stuff there, but there are lots of ways that grats can play a role with other strategies. As far as the wash sale rule is concerned, my personal perspective is I think those days are numbered. I have been an active participant in that myself, and I've been grateful for that. But I think that the days are probably numbered for being able to do wash trades on Bitcoin.
I'll just add one thing, sort of unrelated, but please, please, please remind your clients that there's a box you have to check if you have any transactions in digital currency, because the IRS would love to get somebody on that. It's super simple. You can't just let your accountant do the return and you sign it. Make sure you know that, and as well with offshore accounts, because as the world becomes much more closer to one another, offshore accounts are coming in. If you're a beneficiary, you have to disclose it.
All right, time for cocktails. Thank you, guys.
Thank you.
Appreciate it.